3 months on a simulation account, a 70% win rate. Your equity is a smooth, predictable climb. You feel completely ready. But flip the switch to live money and the grid fractures. The flawless climb collapses into a jagged downward spike. Suddenly, your platform is throwing requote errors. Your tight spreads balloon open the second a news event hits. And sitting there at your desk, your palms are sweating and your heart rate is spiking past 100 beats per minute. Your strategy didn't break, and you haven't hit a streak of bad luck. You have fallen into the simulation gap. To survive a live market, you have to navigate two invisible forces that a demo account entirely hides: the physical constraints of interbank servers and the evolutionary wiring of your own nervous system. When you click buy on a demo account, the local server instantly grants you the price. But in the live interbank market, you aren't trading in a closed loop. Every order has to find a real physical counterparty in a massive global network. This travel time introduces execution latency. Your live order must hop across multiple network nodes to reach a central liquidity provider. It takes milliseconds, but in a fast-moving market, milliseconds dictate whether your trade survives. Say you try to buy during a high volatility event, like a CPI data release. By the time your order reaches the pool, the price has already shifted. The broker has no choice but to kick the order back to you with a requote error. Even if the order connects, you hit the reality of depth of market. Look at this stacked bar chart of available volume. If you place a large order, there might not be enough liquidity sitting at your exact target price. The market has to fill what it can and then move down the line. This causes negative slippage. Because your large order consumes multiple tiers of pricing to get fully filled, your average entry point ends up worse than what you clicked on the screen. The absolute precision you saw in your demo backtest evaporates, and spreads themselves warp dynamically. During periods of low liquidity, like the 5 p.m. Eastern rollover, a spread that was completely flat on demo can widen by 10 or 15 pips in seconds. It will hunt down your stop loss and close your trade before the actual market price even shifts. If your strategy relies on ultra-tight scalping or fractional pip precision, it will fail in a live retail environment. The physical constraints of the routing servers simply make that kind of perfection impossible. But server latency is only half the problem. If your hardware survives the execution, you still have to deal with your own nervous system. When you lose $500 of play money, your brain logs it as a minor tactical error. When you lose $500 of your actual rent money, your brain processes it as a literal threat to your physical survival. Scientists literally call this the amygdala hijacked. Simulation trading operates entirely without cortisol, the human stress hormone. Without that chemical stressor, you never develop the mental callus required to sit calmly through a deep drawdown. Instead, the infinite safety net of a demo account builds toxic muscle memory. You learn to arbitrarily widen your stop losses or over-leverage your position, knowing there is no permanent consequence if you blow the account. You can always hit reset. In the live market, the sudden physiological panic from real risk causes your prefrontal cortex, the logical, strategic center of your brain, to shut down. It hands the wheel directly to your fight-or-flight response. The immediate result is that you abandon your rulebook. You start revenge trading, desperately trying to force the live market to give back your capital instantly. By removing all friction, perfectly safe simulation environments actively train your brain to fail. They teach you how to win without ever building the physical endurance required to not lose. You cannot leap directly from a risk-free $50,000 simulation to a fully funded live account. The combination of technical friction and emotional shock is too severe for the human body. Instead, you build an architectural bridge. You transition using a micro or cent account. By risking a very small amount of real capital, say $10 to $50, you introduce actual skin in the game. It's enough money to trigger a genuine cortisol response and elevate your heart rate, but not enough to ruin your life if you make a mistake. This micro-risk stage forces you to physically practice trading. You learn exactly how your strategy interacts with real interbank latency, widening spreads, and negative slippage. Platforms like FXNX use institutional-grade routing, ultra-low latency execution, and 0.0 pip spreads to eliminate the technical server gap as much as physics allows. But the emotional gap? That is a journey you have to complete on your own. To truly master the markets and transition successfully to a standard NX1 account, You have to respect the friction of real market fills and the heavy weight of real risk.